Hi, welcome to another episode of the Capital Spotlight podcast. I'm your host, Rob Beardsley. Today we have Bob Spiegel from Acuity Partners. Thanks for coming on the show.
Thank you. Thanks for having me.
Yep, my pleasure. So let's jump in. Well, before we jump in, can you please just provide a quick background on yourself as well as your firm?
Sure. So Acuity Partners is a 5-year-old firm. My business background, I've actually been in the investment business, generally speaking, for 30 years. So I think I'm kind of a old timer when it comes to real estate, as most of the guys we're partnering with are guys, 20s and 30s like you. But I still have the energy for it. That's the good news. I started out as a financial advisor on Wall Street and managed stock portfolios for 15 years. I then ran a venture capital fund for 10 years. And so I've had the experience investing in a multitude of different asset classes. My partner and I, thankfully, had done well in those prior businesses, had been investing just as passive, really not knowledgeable investors in other people's real estate deals, and loved it. Again, we're talking probably 5-6 years ago, we were investing in deals. So at much better cap rates, much higher cash flows, fell in love with the whole business model. We know how to raise capital because that's what we've done. We know how to value companies and deals, and a real estate property is not that much different. So that was positive. And we know how to operate businesses. So we felt with all those things, very easy transition. We can make mid-teens returns on real estate, and very simple, no hard work at all. So we shifted our entire business model to real estate and found that although much simpler to understand, just as much work as any other business we've ever done. Frankly, it's, as anyone knows, it's in it actively. You have to love it because it's not a 9-to-5 job. It's a 24/7, really, when you think about it, other than getting some sleep mixed in the middle there. So that's kind of how we got into it and a little bit about my background.
I totally agree. It's funny how you can explain the business so simply, and a lot of people understand real estate. They live in real estate, They work in real estate, they're around it. And so you think, oh, well, I just buy a property and I manage it. Seems pretty simple. Why don't I just do it myself? So that you definitely hear that and see that a lot. But the reality is once you start getting involved, like you said, it's a 24/7 business. It may not be terribly complex, but it is very competitive and challenging.
Exactly.
So first question here is just to get to know your company better. You mentioned that you have a background in raising capital as well as advisory. So today, what is your firm's capital formation process in terms of raising funds or raising on a deal by deal basis? And, who are those investors?
Yeah. So based on the fact that we've sold a couple of properties for nice returns, but I don't think we really have a long enough term track record with numerous sales that would allow us to go out and market that track record to form a fund, right? And I believe a lot of our investors really prefer to analyze deal by deal. They like it. It's not, Bob, even if we had a track record, we know you're doing great, you made money for us, here's $1 million, split it up over your next 5 deals. Many of our guys love the business. They like to get involved and see where the project is located, see the value add we're going to do. So that's a long way of saying that we're always doing things on a deal by deal basis. So we set up your traditional LLC to buy the property. We're the general partner, the sponsor. Our clients are the limited partners. We put up our own capital, always, at least I would say anywhere from 10 to 15% of the equity of a project will come from us. We then have a close-knit group of investors we've been dealing with for 10 or 20 years and our other endeavors. So they always want to see what we're doing, and we'll typically put some money in. And we're always looking, though, to kind of expand our horizons and meet new people. And so I would say each deal we do, we just closed a deal in Atlanta where we brought in, I think there were 25 investors, and 4 of them were new people that had been referred to us or found us on our website. So it's kind of that syndication model, but we're certainly starting out with a good bulk of the cash already rounded up to a degree.
With these private investors, what would you say is the average check size?
We try to keep our minimums at 100. On our last deal, we did kind of two tiers, right? So for someone to put 100,000 in, we did a back end profit share of a 70-30 split. If they could put 300,000 in, we would do a 80-20 profit split. But we're fortunate, very fortunate enough to have a lot of the equity already spoken for. If we like a deal, clients who know us will put money in. Point being that 3 of those new clients had, I think, net worths of $1 million. They're not necessarily people worth $5, $10, $20 million. 2 of them wanted to get to know us, put $50,000 in. So as long as the person's accredited and God forbid something goes wrong, could afford not to get their money out for an extended period of time, we're really open to just meeting people we like to do business with and that could use our services.
So you mentioned you form an LLC, you're the general partner, you put some money in, you raise capital, those are your limited partners. And how does an operating partner fit into that equation?
Yeah. So for example, on the deal we just did, Vinings Apartments in Atlanta, Georgia, 106 units. That deal was brought to us, which might be of interest to some of the people on your call. I'd say 70% of the deals we've done, we have been a co-sponsor. In some cases, we're doing all the operations and asset management ourselves. In this case, a group that we know and respect, young guys like yourself, found this project, had already negotiated, had it in contract. It was a $6.5 million raise. They're growing their business. So really kind of their bandwidth was about $3 to $4 million worth. So they reached out to us. In this case, we acted primarily just as a capital raiser. So we brought in $3 million of the $6.5 million. They will be the guys on the ground doing the operating. So they will be, of course, we've been doing it longer than them. So we'll oversee with them and have our weekly calls with the property manager. And we don't do any in-house property management, right? We're still not big enough in any particular geography to set up our own property management company. So we will use locals that we know or regional property managers that we know. And in this case, we oversee them and do our weekly calls and go out to the property every couple of months. And in this case, our partners, I really consider them to be the operating partner. And we've just figured out the economics as to who's adding what value to the pie and kind of break up the economics that way.
Makes sense. Makes sense. So you mentioned Atlanta. What other markets are you focused on, and how have those focuses changed after the pandemic?
So we haven't had any, unless I'm missing something, which I could learn about from you or others. For us, the markets we're interested in really have not changed. Those markets have not changed due to the pandemic. So we are in where most other people are, which is why it's so competitive, kind of those secondary growth markets. Atlanta is our favorite market. This will have been our 4th acquisition in Atlanta. Earlier this year, we closed a big $30 million, 330 units north of Houston, Texas. And I know you guys do a lot in Texas. We should talk more about that. Do we like Houston as much as Dallas as a growth city? No. But pricing, we love, because many people still say, oh, Houston, oil and floods, no good. Well, if you take any time at all to go there and look at it and see what's happening, as you see, oil maybe used to be 80% of the economy, may now be worth 20 to 25%, and we can get much better deals there. We don't own one property in Dallas, even though it's at the top of our list, because we get outbid every single time. And if we pay too much, the numbers don't work. So we love Texas, any of the big cities in Texas, Atlanta. We sold something earlier this year in Columbia, South Carolina. So we're trying to stay away from the hottest of the hot, the Charlottes, the Nashvilles, the Fort Lauderdales, So I would say primarily Atlanta, Houston. We looked at something in Columbus, so we're trying to go to the Midwest because we thought prices would be a little more reasonable. They're really not. So we're really trying to get our roots into Atlanta and Houston, and that's where most of our acquisitions have been.
Yeah, I couldn't agree with you more. We obviously think very highly of the Dallas-Fort Worth market as well as the other Texas majors, but it's like you said, the pricing is so challenging, so competitive, and it's really hard to justify, a 10 IRR in Dallas where, you could get some better pricing in Houston.
Exactly.
And I agree with you. We preach this all the time, and that obviously Houston is still, has a correlation to oil and gas, just like many markets have, roughly a 20% exposure to, medical or education or military. And,
Yeah.
they've got oil and gas, absolutely. But it's a very big city, right? As you know, it's on trend to become the third largest city in the country. And
Yeah.
it is a diverse, very large, sprawling, diverse city. So there's plenty of interesting pockets to look at. And I think that's similar to Atlanta. Like you said, Atlanta is one of those brand name markets that seemingly everyone wants to be in, from the sponsor and, capital side. But with that being said, Atlanta is also a very large city. And I think it's also a city of haves and have nots. There's some fantastic locations, and then there's some not fantastic locations. And I think some people might be getting trapped in those, paying 70 a door where, things aren't worth that in those markets.
Yeah. Yeah. Sure. Agreed.
So our next question is, well, we actually touched on this, the special privileges for larger checks. I think that's an interesting conversation and something that a lot of people should be implementing into their business, because if you think about traditional businesses, there's typically, multiple tiers of offerings and, buy one, buy two, get one free, that type of thing. And so and it sounds like you implemented that as well. Talk a little bit more about the rationale there, and how you have seen, certain investors go towards, the $300,000 tranche in order to get better economics. Is that enough to push people in that direction, or what do you see the value there?
Yeah. Our partners on the deal had picked out those break points, let's say. To me, what I might have done 100,000 and 500 or 100 and 250. Somehow they picked the 300, but it was very interesting that normally, at this point in our careers with the relationships we have with our clients, unlike when I started out pitching stocks, for lack of a better word, which was a much more aggressive approach. I got passionate about a particular stock, and that passion would come through, sometimes almost in being overly aggressive to get my point across and get someone to invest in my idea that I believed in. Now, as I've mellowed with age, and real estate is not a split-second decision, we just present, if it's of interest, let us know, and how much do you want to invest? So typically, this group of clients that I deal with, this certain, call it sector of my client base, was putting in 150, 200, 250. And when they saw how we marketed this one, before the conversation even came up, okay, I'll take the 300,000. So they certainly had the money to do it. Not everybody does. And to your point, 8 out of 10 people want the bargain. So they're going to maybe put in 100,000 more than they even wanted to on every deal, simply because they're getting a better deal on it. This deal was oversubscribed and very sought after. So you kind of, it's a little bit of a dilemma. We could have filled all the orders with 100, 200,000 and made much more money for ourselves on the back end, because we'd be getting 30, not 20%. But look, in the end, you do whatever you need to do for the deal, and they're your good clients, so you try to take care of them. So it certainly was very well received.
Another thought I'll put out there, and anyone, you and anyone listening wants to think about it more and develop the idea, I think there's definitely a good idea out of this kernel. So, which is something like a frequent flyer mile program, where if you have repeat investors who know, like, and trust you, and they're investing with you on a recurring basis, you might have something like a major investor status, like you said, 500,000 or a million, but they can reach it cumulatively. So if they invest in every deal over the next few years and they're just steadily putting in 100 or 200,000, and then they reach that, whatever that mark is, $1 million, now all of a sudden, they get the first look on your deal, or they get some sort of, like you said, an 80-20 versus a 70-30. Something like that has been on my
I
mind.
like it.
Yeah, I think
Good
that could be
idea.
interesting. So if someone wants to think more about that, please let us know.
Good idea.
So staying on the operator side of the conversation, what are the qualities of a sponsor / operating partner that you look for?
I think, as we talked about before, I don't know any sponsor who's not eating, breathing, and sleeping the business. So I think they need to know that it is, when I say a full-time job, for me, I'm working all the time. And I think this whole virtual world has allowed more people to think that way. So I've never been a person, because I've always had my own businesses. I didn't report to work for somebody and punch in at 9 and leave at 7 or 6 or 5. So to me, I might, as I did last week when the weather got nice here in New York, I took 2 hours out from 1 to 3 p.m. just to go biking in Central Park for a couple of hours. But then I was up at 11 o'clock that night reviewing a number of OMs and doing some underwriting, right? So it's something that if you like it, it's more of a lifestyle than just a job. So the operating partner has to be on the same page with us in terms of that. I don't want to be, my partner is, but I don't want to be the detail guy. So if we can find an operating partner that knows the construction and the rehab, right? I know how to talk to our property manager and how to do the marketing and how to get the right tenant base and how to maintain those tenants and how to communicate with those tenants and be transparent, which has been so important, as you know, the last 9 months. But I'm not going to be the guy to know or to go out and negotiate for what type of vinyl flooring are we going to use. The 2 mil versus the 5. And do we want the low flow toilet? And where are we getting the best deal on that? And do we want to decide on having people putting the washer dryers in and having people rent them to us, right? So a lot of that I can do, just general business sense. But when it comes down really to doing all the renovations and I like to find a partner that maybe started, like many of the people on the podcast probably have, started doing those single family flips or just renting out 2 to 3 family homes for income. And they had to do everything themselves. And many of them did go in there and knocked walls down and decided what type of nails to use. So if I can find an operating partner that has that hands-on experience, like many do, that we don't, because that's not how we got into the business, frankly, other than attention to detail and passion about the project, that would really be the biggest thing I look for.
It makes a lot of sense. It complements your skill sets and your background. That makes a lot of sense.
Yeah.
And then to take it a step further, how are you meeting new potential sponsor partners, and how are you vetting them and performing due diligence on them and as well as their deals?
Yeah. So very good question as it applies to us. I think we're in a good position to address that topic because we got into the business 5 years ago and wanted to get into it in more of an institutional approach, right? We're not, again, I know, this is the hardest part for many people, and it's not easy for us. Don't let me paint the picture in the wrong way. It's not easy for us to raise capital. I see it, I'm on lists that I get from people. New offering. We're buying XYZ in Charlotte, North Carolina. It's a $3 million deal. Please push this button if you want a soft circle. And I don't know if it's real or not, but 3 hours later, thanks for your interest. Our deal is sold out. We'll get you on the next one. So I don't know if it's a marketing tactic. I'm not judging these people. So my point is, even though we're money raising, capital raising guys, it's not easy for us to raise the capital. but that is our strong suit. So we needed to find people to co-sponsor with right up front. So we went to our friends over at Walker Dunlop here in the city, a couple of great guys in Jersey that we do business with, the lenders. And they reached out to us through LinkedIn. We see you guys are a commercial real estate multifamily. Do you have any deals? We'd like to arrange the debt. And we said, well, we don't have any deals. We've just opened our doors, but why don't you find us a deal, a property to acquire? We'll give you the business to find us the debt. Or why don't you find another group that could use some help with the equity? We can co-sponsor with them and still give you the debt. So this one group found us 4 or 5 different potential co-sponsors. And we spoke to all of them. At that time, it was easier to meet in person with them, even though they weren't here in New York, most of them. And so the first thing is just, is it a comfortable conversation? Just like you might be going on a date. Is it comfortable? Is there some kind of chemistry there? And I'd say with 2 of them, there wasn't mutually. Nothing negative at all. It just wasn't somebody might want to work with. So out of 3 of them, we felt very comfortable with them. And we got to know them over a period of time. They weren't in the process of doing a deal at the time. So we reviewed all the past deals that they did. We went to the properties, at least one property for each sponsor, and they walked us through literally from the initial OM and how they found the deal from the broker to every step that they took along the way. It served 2 purposes. 1, due diligence. 2, learning experience for new guys coming into the business. So it's really a matter of the feel and how hard they work at it. How does their underwriting look? Is it exaggerated? Is it too complex? One of the groups we looked at had an 18-tab underwriting model, and not one of the tabs had less than 100 lines and formulas on it. And this person was a former engineer, kind of technical analyst type, that got so caught up in all the numbers that he wasn't really seeing the forest as well as the trees. So even though a great guy, it's not someone that we really thought we could connect with. So it's really by getting to know them over a period of time, reviewing the last deals that they did. Only 2 of them had even sold the property before. So it's not as if we could really look at their track record. But as we talked about before, it's fairly easy to have some concept if you bought something at a reasonable price, right? And how they presented it to their investors. So I think it was based on those things that we were able to get comfortable. And those are kind of some of the things we looked at.
Makes a lot of sense. So talking about the deal specifically in terms of what you're looking for, so we've established the co-sponsor side. Actually, I've got a final question on the sponsor side. How do you mentioned about 70% of your business is co-sponsor, 30% is on your own. Is there a methodology that you have internally that decides whether or not a deal is a good fit for you to do individually or to co-sponsor? Or is it just if a deal comes your way and it's a sponsors attached to it, that's how you'll do it? But are there circumstances where you find the deal and then you try to find a co-sponsor partner to match to that deal?
Yeah, so I'd say it works both ways. So we have a whole team of people out more so before pounding the pavement, making the relationships with the brokers, reading OMs and looking at deals and underwriting deals on our own, right? And most of the deals that we find on our own, we get outbid, in the best and final process. And many times we're going up maybe a small institution or a REIT now, or even buying these $20-30 million properties. And so they're not as sensitive to the overall returns, so they can pay an extra $1 million that we can't afford to pay. That's what we seem to be seeing on our own, because we don't have, honestly, the best broker relationships. We have a good guy in Atlanta, so we're not the first look on these deals. We have to find our own deals. So I would say the ones we have found on our own are kind of the smaller deals, and we'll just do them on our own. If we found a large one where we couldn't raise the capital, which would probably be as you get up to 4 or 5 or 6 million or more, we probably couldn't or wouldn't want to do that on our own, we would reach out. So it's really just luck of the draw. And it's a huge, we have this argument all the time. I don't know if this is getting off topic, but do you want to do all of the work from start to finish yourself and get paid 100% of the economics? Or how about if somebody else does most of the work? They find it, they negotiate it, they arrange the debt, we help with the asset management, and maybe we only get a third of the GP. But really, we spent 2 months raising the money, that's it. And then we oversee them overseeing the project. So you can do a lot more deals that way. You can get some diversification in your deal process. You only own a third versus 100%. So we kind of like both models. Since we couldn't settle on which is best, let's just do a little bit of both, kind of go with the flow.
Got it. So now focusing on the deals specifically, are there certain cash flow and return metrics that you're looking for? Does a deal, for example, need to have a certain minimum going in cash on cash, or are you more opportunistic and willing to see no cash flow for the first year in order to achieve potentially high teens returns? Kind of what is the strike box for you?
Yeah. So I would say if we saw something that wasn't going to pay any cash flow just for the first year, or wasn't throwing off enough cash flow, but based on that, we were able to get it at a lower price and get a high teens return, we would consider that. We're not seeing that really. So we give a preferred return to our investors of 8%. And we were easily able to find deals that covered that 3-4 years ago. Now, because we're paying higher prices and putting more equity in, getting that same cash flow, we're not really hitting those 8%. It's hard to find that. So I think we kind of look for at least 6%. So at least 6% has to be thrown off right now. And kind of our floor on the IRR, generally speaking, would be about 15. So if you go back 3-4 years, we found ones that were throwing off 8 or 9% on the lower equity. And thus the returns we could project 16, 17, 18. Now that's all kind of dropped down a bit, but that's okay.
When you're talking about those 15, 16, 18, are you talking about project level or net returns?
No, we need to show a net return.
Net.
I just feel, maybe it's in my head, that I have to show my investors a 15% return to them IRR. Now, if it comes out to be 14.9%, I could justify that. So that's kind of what we look for.
Got it. Okay. So in terms of transitioning now to more of asset management, investor relations, what are some unique ways that you deliver transparency to your investors?
So the first way, I wouldn't call it unique necessarily, is we have set up a whole portal, as some of these people will, these service providers will present these portals that you could sign up for to manage your whole deal process. So we developed our own with an outside vendor that we think is pretty transparent. You can see what you own, see your distributions, you get your K1s on there. We'll have everything in there. We will put financials in there. I would say everything that we look at, we'll have a data room. So that individual could look at everything right from day one. Where I see a lot of sponsors that are more into the marketing, they try to give as little information as possible, assuming that the investor is not sophisticated, which he may not be. We put it all out there. So in terms of what they can see, even before going into the deal, complete transparency. Once we close the deal, we put all the financials that we're getting in there weekly. We do snapshots once a month. So take all of that data and put it down into one page. Move-ins, move-outs, applications, collections, really, so you can see all that stuff on one page. And then we will even do we do a call with the property manager twice a month. He emails us regularly, obviously. if a client wants to, we will actually put them on the phone call, or we'll tape that call, which we always do for our records. And then we'll give them access to listen to the call. So anything they want to know and see, we will allow them to see. And of course, 95% of them, it's just not something they're interested in. But if they are, it's there.
Yeah. And people, I'm sure, appreciate that it is there. And so even if they never use that, they appreciate that it's there.
Yeah.
What service do you use to record those biweekly phone calls?
We use something called Tape-A-Call. The Tape-A-Call Pro, TAPA. So it looks like Tap-A-Call. I think it's $10 a year for a great service. You can send an audio file, a link to the recording. It's great. You just have to inform the people that are on the call that you're taping the call, have their permission to do it.
Right.
That's a great service.
Yeah, that sounds great. What are the ways that you provide communication and reporting to investors, and what frequency?
Yeah, so we will send out, we do quarterly updates. So we'll do a quarterly newsletter, although it's not really in the newsletter format, on all the deals we've done, our general sense of the marketplace. We'll put some links in, general articles about interest rates or multifamily or collections. So every quarter, they will see a nice summary of their particular properties that they own and kind of the ecosystem that we're operating in. Any update that might be happening at the property, of anything of significance, we'll put it on our, what we call Invest Next is our platform. And once we put a new piece of news there, or an update or a quarterly report, the investor automatically gets an email directing them to log into the portal and see what we've just presented. But we find that quarterly updates really, sometimes are even too much. As you know, for some of these real estate deals, not much might be changing in a 6-month period of time.
Yeah, absolutely. I think it's interesting because there's a lot of people reporting monthly and providing monthly updates, which are more commentary rather than hard numbers. Because like you said, the numbers aren't going to materially change month over month. But I still think that touch is valuable, and investors may not read it, but they appreciate it, that it's coming in and they kind of see what's going on.
Yeah.
Similarly to a distribution, right? More sophisticated or institutional investors, they're comfortable with seeing no distributions for a period of time, like we discussed, if a deal has no cash flow. And they're also very comfortable with the standard quarterly. But I think, just typical high net worth individuals, seeing that ACH or check every month is a really big positive, reinforcer every month.
Yeah. And we always debate that. I think we're currently doing it quarterly. I don't disagree with the monthly. It's a little more work for us, but I'd probably say 60% of our investors would probably prefer the monthly. My partner handles all the accounting, and he only wants to do it quarterly. So no one's really complained yet.
Understood. Well, Bob, greatly appreciate your time being on the show. Please provide listeners more information, ways to learn more about you, Acuity, and to get in touch.
Yeah, sure. So our website is a great way to communicate. AcuityPartnersNYC.com. Acuity, ACUITY, partners plural, NYC.com. And I'm also very active under Bob Spiegel, SPIEGEL, on LinkedIn as well. We provide a lot of information as to what we're doing and communicate that way. So I'd be happy to talk to anybody out there that might be a fit for us.
Fantastic. Well, again, appreciate you coming on the show.
All right, Rob. Thank you. Appreciate the time.